What is lender's mortgage insurance, or otherwise known as LMI? A lot of borrowers out there think that it protects them as the borrower. It actually doesn't. It protects the lender, or does what it says. It's called lender's mortgage insurance. So having a look here in how lender's mortgage insurance works. So we've got a lovely couple here. They're going to buy a property worth approximately $400,000. At Evolve as a broker, we've got access to over 45 lenders. We're going to pick the best loan to suit their situation. Now the lenders or the banks will lend up to 80% of the value of the property with no lender's mortgage insurance. Their way of thinking here is if these guys only owe $320,000 on the property, if for some reason they can't pay their loan, the bank has to come and recover that property to sell it, they're pretty comfortable. They can get their $320, walk away and not lose any money. Now, in an ideal world, everyone would have 20% deposit. In the real world, that doesn't happen. So the lenders will lend over 80%, but they just want some insurance. They want to know if the borrower can't pay the repayments, how are they going to get their money back? Now, on a standalone basis, the maximum that any bank is going to lend is 95%. So in this instance, 95% is $380,000. Now, our lovely two borrowers here, they get their home loan, they owe $380,000. 6 months down the track, they trash the property, they don't make any repayments, and they run away. Now, this leaves a bank with a property that was worth $400,000 that might now only be worth $370,000. Now, for the bank to come in and take that property, fix it up and sell it, it might cost them approximately $20,000 to do so. So this property is worth $370,000. They've spent another $20,000 fixing it up. So essentially that bank has lost $30,000 in this equation. Now that's where we get a second group coming in. These are the lender's mortgage insurers. Now in Australia, there is only two lender's mortgage insurers. Now how they come into the mix, the $30,000 loss that happened before, the mortgage insurer will pay the bank that loss. So the bank hasn't lost anything. The mortgage insurer will then chase the borrowers to pay that $30,000. So like we said, it doesn't protect the borrower at all. It does protect the bank, and unfortunately, if the loan's over 80%, the borrower has to pay for it. So lenders and mortgage insurance is something that is a necessity at times. All banks do have slightly different premiums, but at Evolve, we make sure that we minimize this as much as we can for our clients, or if possible, try and get around it so that they can save their money on that next purchase.